In the month of August, I made a gross profit of $185,000. I had a 50% win rate, and my average win to loss ratio was about 7 to 1. And in this video, I want to break down the type of setups that I'm taking. I want to talk about my risk management system. And I also want to go over my best days and show you actual trade examples of what makes me confirm the setup, where do I place my stop loss, and then I want to talk about some of my worst trading days and really why I have larger losing days and more quantity of trades in the red days. I wanted to start this video by explaining something for traders who are looking to develop and build a system or build an edge in the markets that gives them long-term success. I still do this to this day because it keeps me on my toes in regards to only taking setups that I know work out for me the best and have the highest probability of working out in my favor. So a good little tweak or lesson to do is being able to label the type of trading setup that you are going to take before you take it. If you can label that setup before entering it, it's going to force you to take trades that you know works out for you the best. And if you can't do this, more than likely it's a trade that you should not be taking because it's something that you are not used to. It's something that you have not tested. And it's basically you entering the market blindly because you're entering without a valid trading setup. And you could also enter because you're thinking something is going to occur without factual pieces of information the market's providing you. So these are basically the setups that I look for, and you're going to see in the trades that I take. I'm gonna show you the examples of the setups. I'm going to get into some of these so you can see what they look like and how I trade them, because this is the core foundation to my trading setups and what I look for on a daily basis. So good lesson, good little thing to implement into your trading because it will force you to take great setups and it will force you to trade around your system and your edge. One thing I do want to say in the beginning of this video is that I standardize my risk on a per trade basis. What I mean is I keep my risk consistent and I will adjust my size depending on where my stop loss is placed. My risk is anywhere between $3,000 to $4,000 based on the setup. In this trade, I was risking about $3,700, $4,000 to make about $18,000 in profit. It was about a 5 to 1 risk to reward ratio, and I got a little slippage on this by a tick, and I lost a little over $4,000. Now, this setup is what I call trapped sellers. Now, a very big premise to my trading system is looking and capitalizing on pain in the markets. I am looking for where a lot of effort is being placed, yet no reward, or I'm looking for where there's a lot of traders entering and stopping out of a trade because where there is pain will be the greatest gain for me to enter. In this example, we could see a classic trend line. They are very simple to draw. Everybody draws them, and this is kind of where context comes in. You can't just draw a random trend line or a random support resistance level and make a trading decision off of that. Context is very significant when forming a thesis around the market structure. What I mean by this is in the pre-market plan, I post these every single day of the setups I'm watching, levels I'm looking out for. And the main thing for this day on August 29th was I was watching for a breakout above a major resistance level. It was a very key level, and these levels tend to be broken based off of the volume that formed off of this level. So my thesis was if the market could break out above the resistance level at 56.41, then longs are in play targeting the supply zone above. The market had opened up. We were right at the key level. The market had broken under this trend line, and I was comfortable putting risk on down there when that trend line was broken. It's a classic example of sellers shorting a break under the low, a break under the trend line, thinking the market's going to collapse, not putting context together and understanding they are just liquidity for other traders who are smart or other traders who are looking to get filled a larger position to move the market in the opposing direction. So the market comes to this trend line. I get in the market long, it sells off, and I stop out of this trade. The thesis was the trend line was breaking. I'm going to get long and buy from those who are selling, speculating the market will break above this level of resistance, and I could play long, speculating that level will act like a magnetic force to the market. How I trade, and I made a video of this, was if X level breaks, then Y level could trade. So if the level of supply breaks or the level of resistance breaks, then there's no other supply or no other resistance until much higher. And that's kind of how I'm speculating or basing my trades off of this analysis. So I stopped out of this trade for a $4,000 loss. Now the next setup happened about 5 minutes later, and this was the same thing, about a $3,000 to $4,000 worth of risk. a 6-to-1 planned risk to reward ratio for a $20,000 profit, going for that supply zone above to trade. In this example, it's a classic. Now we have more confluence to the setup. We have a low of day right here. The market had broken under the low of day and had broken under the trend line. Two pieces of confluence there, speculating that somebody is buying this move. If there's a lot of selling volume in the market, you can see the volume had increased as the market was breaking under this trend line. If there's a lot of volume, yet no continuation, it's a good sign the market will move in the opposing direction. So as it broke under this low of day, I was comfortable putting risk on long down here at 56.23, placing my stop loss 2 points under price, going for a 10 to 18 point reward to the upside. Failed lower day break attempt, going for a breakout, heavy volume, and scaling out along the way. So essentially, I am looking for max pain, or where traders are shorting, where there's a lot of effort but no reward, and getting on the opposing side of the market, speculating that the next level of resistance or next level of support will trade. And the third trade this day was the same thing. It was about $4,000 worth of risk, 5-to-1 risk to reward ratio, and the thesis for this was longing the pullback into this same area that the buyers appeared down here, speculating that supply zone will trade. The levels of supply, or the levels of resistance, or the levels of demand and the levels of support usually act like magnetic forces. So my idea is getting long before those levels trade, speculating that those levels will trigger at some point because the market likes gravitating towards them because they are highly liquid areas where a lot of transactional volume occurs there. All right, now this is the same example just flipped as we're looking for trapped buyers. Now I'm going to get a little more in depth how to confirm this better using order flow and talking about a depth of market and a heat map with the context of a candlestick chart. So here on August 14th, the market had CPI data. We get this news released about an hour before the New York session opens up, where usually we see a large volatile move. Now, I've noticed that when the move is kind of muted, where we don't get a larger move up or down, I tend to look for reversals on an intraday perspective. For example, on this day, my scenario number one was looking for selling pressure to play short inside 54.65, which is this yellow line right here. Because how muted the reaction was post CPI, I'm looking for a reversal, and in this context, at the level of resistance, which is the yellow line, I'm looking for selling pressure to play short on a strong rally up higher. And my issue with this trade was I did not standardize my risk. Look at my risk to reward ratio on this setup. It was about a 9-to-1 risk. And entering with tools such as a depth of market over here, it enables me to get such tight entries with very small risk. So this was a 9-to-1. My risk was about $1,800. What I could have done here was doubled my size, because what this would have done is standardize my risk to what I am comfortable losing, and this would have resulted in, if the trade hit, which it did, the profits to also be double while maintaining the same risk that I have accepted and comfortable losing. So this was a 9-to-1 risk to reward ratio. This trade lasted about 10 minutes long. I risked $1,800 to make $17,000 off of trapped buyers based off of the CPI data. So the market opened up. We rallied up into this level. I was looking for reversals intraday, and within the first 2-3 minutes, I got short on a really strong rally up due to strong buying effort, yet no upside continuation. A lot of effort, but no reward is a good indication the market will auction in the opposing direction when the context fits. So I took this trade short at 54.68 with a 2-point stop loss, going for an 11 to 18 point target to the downside. Market opens up directly above my yellow line, which is the level of resistance. And within the first 1-2 minute candles, we could see a strong rally up. And look at how strong the buying volume was in the first minute. And that got completely cut in about half with more selling volume directly after that first 1 minute candle. Now, introducing a little more into the concepts of volume, I'm going to replay this data here. And keep in mind, my level was at 54.65, which the market is opening directly above it. I'm going to speed up this replay, and I want you all to keep an eye on the strong green bubbles or the strong blue delta prints that come in as the market is breaking out in the first minute. Look at all the strong VPD column, which is the volume profile delta, ask minus bid volume, as the market's rallying above the resistance level. We can see a lot of strong green bubbles or strong trades hitting the offer in the first minute. What this tells me is a lot of trades are aggressively entering the market and hitting the offer, which also can be seen as aggressive buy orders. Whether it be a new buyer or a seller covering, it doesn't really matter, but that's where context is important. But the premise here is the market's breaking above a resistance level. We see a lot of trades hitting the offer. In this example, if we are bullish buying a breakout, I would want to see the market continue moving up higher and not really stall out here or move sideways. What we're going to see here in the first minute, this is 9:30 Eastern time, in the first 1 minute of the market being open, breaking above the resistance level, we see all of this buying and watch how it immediately is going to fail here. Right? Strong buying, really coming in. And then all of a sudden it fails and the selling steps in thereafter. And this is where I'm comfortable putting risk on short here, placing my stop loss above the high of day. I'm entering when the volume's telling me to enter. I'm not waiting for a 5-minute candle to close. I'm seeing a lot of buying volume. I'm seeing the buying dry out, sellers step in above a resistance level post CPI. And this is an entry signal for me to get in because it enables me to get in before the move happens with the smallest risk and the highest reward. The market had dumped after that directly into my target. And this was a trade that lasted 5-10 minutes. And it just was so smooth reading all of the volume that's being transacted in the market. So really how I'm able to pinpoint this and validate and confirm my setups is reading the volume and understanding what's going on behind the scenes that truly cannot be seen strictly off of a candlestick chart. And then we get the strong dump there after that. You can see all the failed buying up here at the highs above the resistance level. And I'm going for quick scalps. I'm not going for 50-point moves. I'm not making the trade last all day long. I'm looking for where there's pain because usually those traders will stop out, cause a reaction, and this is when I could capitalize on a quick scalping move directly into my target. So this trade is what I call volume continuation or acceptance at higher or lower prices. In this example, it was acceptance at higher prices. Similarly, about $4,000 worth of risk, about an 8-to-1 risk to reward ratio. I sold this thing for about a 5-to-1 because I exited some of the position a little early. Now, the premise to this strategy is context is key. And like I said earlier, if X level holds, then there's nothing stopping the market from going to Y level. I also made a video on this specifically on my YouTube channel. So the market bounces off of this level of support, and I don't see any resistance until the supply zone above at 53.29, which is this pink level of supply. Now, what I mean by acceptance at prices higher or continuation is usually in strong uptrending markets or strong downtrending markets. If there's a lot of volume, and in this example, we had an uptrending market, on the periods of pullbacks or on the periods of consolidation, if there's a lot of selling volume, but the market is not compensating for that selling volume, it's a good indication that a buyer is present in the market and higher prices are likely. What we're going to see here is in this range where the market consolidates and pulls back, there's a lot of selling volume, yet we really didn't sell off or form a high there despite all of the selling volume. You have to think about that as a red flag that somebody, whoever is selling into the market, somebody also has to be buying. If the market's not moving down, whoever is buying is supporting the market, and most likely the level of supply will act like a magnetic force where the market can gravitate towards. If this level holds, then Y level above us could trade. And the Y level is the level of supply. So this period of consolidation over here, which is the yellow oval, was around 10:05 Eastern time to call it about 10:20 Eastern time, about a 20-minute range. Now pulling up the volume, again, volume confirms my thesis, volume confirms my analysis. Without volume, without reading the order flow, to be honest, I'm blind and I'm lost in the market. I need to confirm it with what's going on behind the scenes. In this example, yes, you see the market flagging or consolidating, but I need to know why that is occurring. Why it's occurring is somebody is passively absorbing all of this selling pressure. So 10:05 is right here to about 10:20. You can see all of the selling volume, aka green bubbles, or trades which are hitting the bid. In this period, despite all of this selling, you could see the cumulative delta downtrending. So there's more trades hitting the bid than trades hitting the offer. And despite this, the market is actually still uptrending and consolidating. Somebody is buying from whoever is selling or whoever is trying to bring the market lower. This was my confirmation and thesis, and a good indication the market is accepting these prices and continuation is higher. I like getting in these periods of consolidation in the trending markets. It has to be a trending market for continuation to the upside levels. And this was the thesis for this entry on this period of consolidation. And now this is what I call large buyer or large seller defending price. In this example, the market had a really strong sell-off and then rebounded and starts to trade where we were prior to that large sell-off on volume. Now on this rebound at 56.31, 56.29, there was some significant buying activity, which what I call a large buyer present in the market. So I know if this large buyer holds and defends price, then it's likely upside prices will trade and will be broken. If then statements, if this level holds or if X level breaks, then it's most likely that Y level will trade. And that's the premise to this strategy as well. So on this large sell-off right here, you could see it on elevated volume. We got the rebound up, and right here at 56.31 to 56.29 is where the strong buyer came in. And what this looks like off of the tape is some really large volume, and some people will call this a low volume node because of how strong and aggressive the market moved in that direction. Again, these are all terms that are interchangeable. So this became a level of interest due to the low volume node can be best be seen off of the tape. The market had pulled back into this level. Look at the elevated volume as the market pulled back into this level of interest. I'm going to replay this data here. Watch when the market pulls back into this level. You can see how the volume spikes right there and then an immediate reclaim. When I see that, I'm not hesitating. I'm entering. As soon as I see this level of interest at 56.31, 56.29 holds, placing my stop loss under that low. And this is what enables me to get in at the right time. And when I get in at the right time, it offers the best risk to reward ratio. If X level holds, which is this yellow oval, then it's likely Y level will trade, and that's the high a day or the supply zone above price. Large buyer defending prices down here was the setup for this trade. And some other things I really want to talk about is if we were to look at my green days or the best trading days, they really only have one trade versus the red days or the days that I've lost money on have multiple trades. Now, let's dive a little deeper into, right? You could see this from an external perspective, but you don't know what's going on in my head. This month, like I said earlier, has been the most consistent. It seems like everything I'm doing is right. All my analysis is playing out. I'm entering the market and I'm like, man, nothing could go wrong on me. And when I feel like this, or anybody could relate, just know that the market could humble you really quick. And every day I was entering, feeling like the trade was going to profit. I was going to make money in 10 minutes. I was going to go walk out, close my computer, and go enjoy the rest of my day. And yes, I'm blessed. Some days, or majority of days actually this month, that was the case. But there were some days where I approached the market with that mindset, thinking that, oh, this thing's going to bounce here, or this thing's going to sell off. And I'm so right on this because of how hot I am this month that it blinded me from the truth. And I usually have approached the market that day with a bias. Now this spirals because I'll take one losing trade and then I'll try it again and I'll try it again and I'll try it again. And that's how I'll have 4 trades on this $12,000 losing day or 4 trades on this $7,000 losing day because I'm stubborn. I'm saying, Carmine, nah, this thing is eventually going to work out. Take these paper cuts now. Maybe your 4th or 5th attempt is going to work out. Now, that is me going against the market because my bias is telling me I'm going to be right or I'm going to win and I'm going to profit because of how much of a hot streak I was on and how invincible I felt by really nothing was going wrong this month. And these 2 biggest red days was because of that. They were both 4 trades where I basically was completely wrong with my analysis. And I really didn't throw in the towel. I was wrong. I couldn't accept that I was wrong. And I wanted to accept that at some point that day I was going to be right. Now, usually that happens. I'll take a trade and I'll stop out for a loss. And just because you have a losing trade does not mean to throw in the towel and completely void that analysis. Some of my best trades, even from the previous months, where I'll take a setup, it doesn't work out on me. Then 5 minutes later, I'll take the same setup with a better price, and that second trade will work out on me. And we could kind of see that on the 29th. That first trade that I took was a losing trade, and then the 2 trades after that were off the same setup, and those were the profitable ones. So I don't want people thinking that if you take a loss that you're completely wrong on your analysis. I just want people to learn, and I have to learn for myself, because this is kind of like the first time I felt this internally to this degree, was how stubborn I was with my trading, that I couldn't throw out my analysis, because more than half of the time this month, I was right on my analysis. So it's kind of like me being cocky with myself or overly confident to the fact that I was letting my emotions some days when I was completely wrong do the trading, and my emotions weren't letting me void the analysis when the market was telling me to void it. You should only void your analysis when the market tells you to void your analysis. You shouldn't void the analysis when you think you should avoid the analysis. Thinking gets you nowhere. Just simply do what the market's telling you. If you can approach the market with a clear mind every day, confidence in your system, confidence in your setup, and you can manage your risk around it, this is when you will build the consistency. The consistency will not come if you have large losses, you let your emotions do the trading, you're stubborn with your trading, that you can't cut your losses when your thesis becomes invalidated, and when you overtrade, where you're taking trades based off of your thoughts, or you're taking trades based off of where you think the market will head next. The market could really humble you fast. So instead of looking at the dollar amount, look at the R multiple. If your losing days are -1 R, -1.5 R, maybe because you have multiple losing trades in a single day, that's fine. But you have to make sure your winning days are over 2-1, 3-1, 4-1. They're at least double your losing days, because what that's going to do is it's going to make your P&L calendar or your P&L curve look like an uptrending chart. It's inevitable to lose. We're going to lose. We're going to struggle some days. We're going to struggle some weeks. We're going to struggle some months. In fact, there was a lot of people that came to me this month and said they really struggled. And in the market, it's all about perspective. When somebody else is struggling, somebody else might be having a really successful month. So don't ever put your head down. The one thing I have to say is, when you have something that works, follow that and manage your risk around it. If your losses are taking 2x, 3x your wins, and your P&L curve is looking like a downtrending chart, then switch your approach, because something is not working in trading, and most of the time it's due to your risk management. Never throw in the towel. Simply use it to wipe the sweat off. Go back in the market and start hitting great setups where your risk is managed properly. And also, a good tip for developing traders looking to build the confidence in a system is label your setups. Figure out how many times those setups work. What's your risk around it? What conditions do those setups are they presented in? Label the setups so you know what setups to look out for, and then your job as a trader is to locate these opportunities and manage your risk around them. So I'm going to end the video on that note. If you learned anything from this, if you want more breakdowns, let me know. If you're new, comment, subscribe to my channel, and drop a like on this video. I would really appreciate it. I'm ending it. Peace out.